Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Alex, welcome back to the podcast.
Hey, Owen, how are you? Thanks for having me.
It's good to chat, mate. It's always good to chat. Today, we've got 10 questions with a financial advisor, being you, and I've broken them down into 4 investing questions, 2 family-style questions, 2 super questions, and then 1 business question, because I know you deal with people in their 20s, 30s, 40s, 50s, and even beyond. And you'll have people that are sole traders, you'll have people that are planning for a family or just wanting to invest. So we're going to cover kind of lots of different bits of ground today. Now, people know you, you're co-founder, director of Everest Wealth, financial advisors right across Australia, including, as we were just talking off-air, some new team members in my hometown, which is Melbourne, which is great to see. There's a lot to talk about today. I figured one way that we could start this is just to talk about the stock market and what's going on in the world. Last time we spoke, Donald Trump was not the US president, but now he is, and it's kind of shaken people up and the stock market's fallen a little bit. So my question is a broad one to begin with. This is in the investing categories. Like, are you worried about the impact of what we've seen from the United States, in particular, the like Donald Trump kind of commentary around tariffs and that type of thing? And I'm thinking about like the way you manage your clients' money or help them manage their money.
Yeah, so like you said, last time we were chatting, Mr. Trump wasn't quite in office yet, and now he is. And as we know, he likes to make big moves and shake things up, and he's trying to buy Greenland and Canada and whatever else he's trying to do. So, look, it's not I guess a concern what he's doing or trying to do per se, but I guess sort of, and I will sort of get to this question, I guess, more specifically in just a sec, but I guess broadly at the end of the day, like, there's also not a lot you can do necessarily as an individual either, or as a sort of investor. So I think, like all things, it comes down to, first and foremost, what your time frame is. So how long you're looking to invest, and if it is a longer term time frame, so 10 years, then you can somewhat sort of block out this noise in terms of what's happening sort of in the shorter term. If you are doing a more of a shorter term investment time frame, so sub sort of 2 years or 3 years or something like that, then this is potentially something to look at a bit more closely. And that's when it all comes back to then getting your asset allocation correct, right? So if it is much more longer term, so 10 plus years, shares and property have always outperformed cash historically, but they are a lot more volatile. And this is an example of, I guess, that volatility in the short term. Okay, so market was flying towards the end of last year, and I guess the start of this year as well. And now this has come in, and it's had a pretty decent correction. May continue, may not. At the end of the day, we don't really know. We don't have a crystal ball. We don't exactly know how these potential tariffs are going to play out for everyone and everything. But it comes down to, what you can manage and what you can control. So again, at a higher or more broad level, if you are looking for a longer term investment, it's only committing money that you can afford to lose, or you're not going to need for a long period of time. And if you are looking at a much sort of shorter term strategy, then potentially safer assets like cash, as an example, maybe a better bet at this point in time, particularly given where I guess our interest rates are still out. You can get some pretty good return simply on your cash or in a term deposit at this point in time too, as well. So, and I guess getting a little bit more specific with it to a degree, it's like, it's just hard to know how much this is going to impact us or not. So these 25% tariffs that he's looking to impose on steel and aluminium imports from Oz. I read somewhere that what we export in terms of these metals to the US constitutes less than 0.2% of our total export value, as an example. I guess more sort of geopolitical sort of things. in terms of what they're sort of after from a defense spending perspective. So I think there's some expectation that we'll have to potentially up our defense spending to match what the US expects, as an example. And I guess, the way that we've tried to manage it from a political point of view is not to put tariffs back on the US the other way. They're just trying to obviously manage it with negotiations and basically having a chat. And so, come on, be reasonable. We're all friends at the end of the day, aren't we?
Yeah, hopefully. But it does spook people, and that's why having a financial advisor too is such a good step for folks. Because if this is someone, if you're watching this or listening to this, and this is your first rodeo, Alex and myself, we've seen a lot of this stuff before, including the first time Mr. Trump was a president as well. And some people remember the trade war that then unfolded, not just with the US, but also just with China and all different types of things coming into COVID. That was a very uncertain time. So I think one of the things for me, mate, is kind of like we have been here before in terms of like uncertainty is probably the thing that's always certain in investing.
That's right. And we're going to share this this chart a bit later down, but I actually think now, if you don't mind, can you share my screen?
Absolutely.
This is actually going to be
it's up now.
Perfect, relevant to this question as well. So what we're looking at here is about the last 30 years of markets. So this is to the 30th of June 2024, before obviously Trump got in for his second term. And if I can zoom this in a bit here.
So we've got the Vanguard interactive chart here, which people will be familiar with. There we go. We've zoomed in.
Yeah, so it's the last 30 years. So 1994 to the end of, or to the middle of 2024. Why I'm zooming in here is to try to show you that what this has also got is who was president. So who was president and who was prime minister at that point in time for us. So you can see along the top, the Howard administration, Bush administration,
Gillard, Rudd,
Trump
Rudd,
was
Gillard,
here.
Rudd.
Yeah. Remember that debacle? That's all in there. And then I'll go back to this so we can sort of see the whole thing as one. And you can see, so over on the right here, you've got the US share market over the last 30 years or so, the Aussie share market, international property, and then cash is this gray line. And you can see cash is a very, very, even steady line over that entire period of time, because there is no volatility in cash. It's effectively, the risk-free return rate in that example. Whereas the top four asset classes, in any short period of time, they bounce around a lot. You can see here there's quite a sharp drawdown. That was COVID as an example.
Yes,
so you can see that. Over here was the global financial crisis as part of that as well. But the point is, if you zoom out far enough, and again, you do have a long-term investment horizon with your investment, you can draw an even, or I guess a gradient line that's a lot steeper than the cash line through these assets as an average. So for example, it's a little bit hard to see here, but the US share market over that period of time, so 1994 to 2024, returned 11.1%. And the Australian market did 9.1%, and cash only did 4.2%.
And that's when cash, like interest rates on term deposits and stuff, was pretty high.
That's right. Yeah. So you can stop sharing that screen now.
Yeah, sure. So basically, like that, I think the reason I love those charts and the Vanguard interactive chart in particular is because it does show those things. It also shows like when there were like major political events, like people old enough will remember things like the early 2000s. There was Middle East conflict and the Iraq War. There's been numerous forms of like really major political war, defense issues that have come up, in addition to all of the things that people just worry about in the stock market, like interest rates, the global financial crisis. Like there's almost always something to worry about.
Like the Russian-Ukrainian war is obviously a recent one, which is still ongoing, unfortunately. But, it's not like the world has moved on or anything like that. But, financial markets have calmed down again as a result, because when that happened, there was a bit of an oil crisis as a result. And again, people didn't know if other people were going to get dragged into the war. So there's always going to be uncertainty, unfortunately, in the short term. That's life. So again, it just comes back to what is your longer term strategy? And that's, like you said, something that a financial advisor can obviously help you with and think about to make sure you don't make any reactive or sort of rash decisions when things like this are happening as well.
I think right now, like you said, we just come off a period where people probably made a lot of what I characterize as kind of easier money, where the stock market was kind of going up, everything was kind of going up around you. And then you get to this moment and you realize, hold on a second, I don't have that much experience with this, and maybe paying a financial advisor is going to pay for itself many times over. I'd like to now go to my second question, which is like back to basics, which is kind of like where people get stuck. So if the later on times is like what's going on in the world is where people get stuck. The very first instance, analysis paralysis, people have heard it on the show, is like even just choosing an investment platform. Now, you guys, over the course of a year, you and the team at Everest see hundreds of clients from across Australia. A lot of them are investors. And I'm just curious, like, you don't have to say like this percent uses that or whatever, but I'm just curious, like what you guys see coming through or what you see specifically coming through in terms of like the investing platforms that people tend to use to get exposure to investing.
Yeah, it's a great question. So at Everest Wealth, we're self-licensed, so we're effectively product agnostic. Like we have no allegiance to any super fund, investing platform, insurance company, anything like that. So at the end of the day, we're happy to use whoever we need to, which is going to fit the best strategy for our clients. So
Yep.
as a result of that, we use a range, to be honest, and we have lots of different sort of decisions trees within the business, which sort of help us get to the options that we're going to potentially talk to our clients about. And things that we sort of consider is, how much you're looking to invest to begin with, how much are you going to be able to invest on an ongoing basis, how long are you looking to invest it? These are some of, I guess, the broad things we consider to begin with.
Mm.
Fees is a massive one for us, to be honest, because a lot of our clients, will have less than 50 grand to invest to begin with, and they might put in, $1,000 a month or something like that, which is perfectly fine, because most of our clients are at the younger demographic and they've got plenty of time for that money to compound and grow. So we'll look at, so one of the key things is how much is, like, so when I say fees, like brokerage as an example. So how much is it going to cost to make that purchase? I guess within the specific investment, we also look at what's called the MER, which is the manager's expense ratio. So how much is it going to cost to have that investment too? But coming back more to, I guess, specific investing platforms, again, so brokerage, functionality. So, making sure that obviously you can use it, because at the end of the day, cheapest isn't always best every single time. Again, so there is obviously a lot of emphasis on fees. We look at whether having a CHESS-sponsored broker is important to you, as an example, because some people care about that, some people don't. Some people don't know what that means, in which case we sort of explain, what it is and how it could broadly affect you one way or the other. Because typically a CHESS-sponsored broker will be more expensive than the alternative. To throw out some names in terms of what we do use from time to time, for non-CHESS sponsored, we might look at using BetaShares Direct is sort of probably the one that we're using most at the moment, and that's typically because the brokerage can be free in some instances. In that case. So you got $500 to invest, you get $500 invested, which is great. They also do, how am I going to describe this? Like partial unitized ETF investments as well. So what I mean by that, probably explain it very well, is basically if the ETF is, say, $26.31, it's not going to evenly go into $500. Okay, one unit of that per se. Whereas, with BetaShares, you can buy a partial unit of it. So effectively, you can get that full sort of $500 invested, which again
so
is
it kind of like rounds off to 500. Like there's like you're only a part of one at the end.
That's right. Yeah, which is what a lot of the micro investing apps allow you to do, like, Raise or Spaceship or something like that as well, as an example. If it's more CHESS sponsored, then generally we'll look at Perla or Stake. Main reasons we typically look at them is, again, from a fee perspective, and functionality. They're pretty good as well. Pretty new platforms to use as well. And then look right up to, so as an advisor, we're going to have every product that the public has available we can use, and do use often as well, by the way, plus a whole list of other sort of products, which where appropriate we'll use from time to time. And depending on the amount of money, again, that you have to invest, or from an ongoing perspective, what's more like more advisor platform, I guess, or something like it's called Hub24 is that company. They also do super fund as well, or Net Wealth is another example. These can become very cost effective at certain amounts of money as well, where potentially they are a better way to go than, say, they're more of your sort of stock standard sort of brokerage or investment platform choices as well.
So there's a lot in there. Like obviously we could do 5 whole episodes about the different platforms, but I think you've shortlisted in not saying it's a recommendation, read the disclosure documents and everything. But I think that those are the most popular in our community, or at least many of the most popular. And then, Hub24, Net Wealth for financial advisors are super popular. And I often get the question from older clients is like, are these things safe? Like, are those, because typically they don't have exposure to hubs and the Net Wealth. So the easiest way to go and check that out is obviously just to ask your advisor, but they're publicly listed companies. So they're on the stock exchange. You can go and look at their financials. You can make sure they're safe by looking at all the publicly available information, pardon me, which is a great resource for anyone that is a bit concerned. But they're huge platforms, really well established. So a good shortlist there anyway, mate. Okay, question number three. And this is something that we've spoken about in the past. We did a live show about it as well, which is like really, really popular. It's a bit further down the line in terms of investment strategies. But this idea of debt recycling, I think it's become, maybe, I don't know, maybe our community is just talking about it more recently, but like the idea of debt recycling and using like a loan to invest in shares for the long term, or ETFs. I guess this is less specific, or more more general to like the theme of debt recycling. Do you worry about too many people using debt recycling, or is it something that done prudently you're okay with?
Yeah, I think it's probably more the latter. Like, again, not to pump our tires up too much, anything like that, but I think we go through a pretty robust process with clients when they want to consider it and whether we would consider it as well. I definitely would agree that it does seem like it's a little bit of a sort of the flavor of the month as well, which is, again, it's a very sound strategy, or can be a very sound strategy. So it's definitely not like a fad or something like that either. It's been around for forever, basically, a very, very long time. But I think it's come to the forefront of a lot of people, in general, sort of hearing about it for the first time, being like, oh, John does that, and he's done really well, like, so I should do that. Which, look, sometimes you should, but again, there's a sort of a few things to consider. So I guess if we strip it back to begin with, like, what is it? Okay, so it's effectively a strategy which is used to convert non-deductible debt into deductible debt. Okay, so non-deductible debt being like your home loan, as an example.
Mm-hmm. So you can't claim a tax deduction for your home loan payments.
You can't claim an interest deduction. So interest, repayment on those home loan repayments, as you said. Yeah, correct. But when you invest money, okay, so if you buy an investment property as an example, typically you use debt for that, and then you can claim that interest as a tax deduction. Right, that's how most people are familiar with that strategy. What this is effectively doing is, first and foremost, you can take some equity out of your principal place of residence or your home. So maybe it's worth $1 million and you owe $500,000 on that. Okay, broad numbers. You've got $500,000 then of equity, which you can then pull out to do something with. So first and foremost, you would get a refinance to effectively do that, and then you would look to invest that money. Okay, so you take a $500,000 loan, and you effectively go and invest that money. All right. The tweak on that is that's effectively a gearing strategy, first and foremost. So not to be confused with then, say, a specific debt recycling strategy in that example, because that's basically taking on more debt. Okay, so how it would work with the debt recycling strategy, which is often confused, is, again, house is worth $1 million, you owe $500,000, you go and take $200,000 of cash and pay that against your $500,000 mortgage. Okay, now you only owe $300,000. Okay, then you effectively can, say, redraw that $200,000 back now as a loan. Okay, so the loan goes back up to $500,000, but you instead use that $200,000 to invest into something else. Okay, so typically, income producing assets are, like you say, so dividend paying stocks are quite popular typically within the strategy. And the reason for that is then they produce more income, which allows you then to have more income to then pay down more of the $300,000 part of the loan, which is still non-deductible. So you can then basically rinse and repeat the process.
Yep.
Does that make sense so far?
Oh, yeah. I think it's like the broad concept is what's really important here. Is like you're turning, say, cash or something, or like some equity, that you might have, and then you can effectively use that by working together with the bank or with the financial advisor to oversee this. I think the thing is that I wanted to get from this, mate, is that I think that a lot of people know it in principle, but I think this is one of those strategies where seeing a financial advisor is really good practice, even if it's just for the first year or something. Like, I feel like, because it's important for people to get right, you know?
That's right. So I'll quickly run you through, I guess, like three kind of key things. So I guess the key benefits of it, to sort of sum it up.
Sure.
Tax deductibility. Okay, so effectively you can turn a non-deductible loan into a deductible loan. Wealth accumulation. Okay, so effectively you're now taking this money and investing it elsewhere, so hopefully it grows over time, and you can effectively eventually pay down your non-deductible debt faster as well as part of that. So that's sort of the three key broad benefits of it. Risks to consider, which is obviously pretty important. Investment volatility, like we were just talking about before. So markets go up, markets go down in the short term. So if Trump decides to do something which is negative, that can potentially hurt your investment as part of that. Interest rate risks. So typically the higher interest rates, the less strategy, so the less effective the strategy can be, okay? Because the closer interest rates go to what the market sort of returns, then you're getting, less reward basically for that extra risk. As part of that. In terms of, I guess, broadly whether you should consider or not, generally people that, or clients that should consider it to begin with, like, firstly, strong financial discipline. So really have the cash flows on lock, understand everything else that's going on, and, as much as possible coming into a decent period of stability within their lives. Homeowners with equity. So you've got to have equity in the property to begin with to do this. And again, it's typically going to favor people on higher tax brackets as well to get some more tax efficiency than, say, if you're only earning, for example, $20,000 or something like that, it's not a good strategy because you're not going to save any tax from that perspective.
Because you're not effectively paying tax in the first place.
That's right.
Yeah, that makes sense. Okay, so we did a whole session on that, which was really great. And I think you explained it better than anyone that we've had on the show before. So if folks are interested there, I'll make sure there's a link available in the show notes to that. Our final question to cap off these investing questions. So this is the fourth one, which is like, what's the number one thing that stops people from investing? You've seen, if not hundreds, maybe thousands of clients through Everest. What is the number one thing, if you could boil it down to one thing that stops people?
Yep. So there's a bit of a shorter answer, this one, because I'm sure people are sick of me giving long answers, but effectively it's fear, to be honest, at the end of the day. It's fear around losing money, which pretty much all of us have, which you have if you're a human generally, if your brain is functions like most of us. There are people out there that
maybe doesn't apply.
Doesn't always apply necessarily. And what it is, it's fear of market volatility. It's the fear of the unknown. It's the fear of making a mistake. It's a fear of like bad timing as well. And, to your point, I guess for question one, again, around like, this bit of the market correction with Trump and his tariffs, already I'm getting a few texts and calls and emails being like, what's going on? Should we be worried? Et cetera, which again is fair enough. But that is the main thing that stops people from investing. They're always like waiting for the perfect time a lot of the time, which the perfect time is never. The perfect time really was yesterday, when it comes to a compounding perspective. So that's what we talk about a lot with clients. And again, really knowing your cash flows as much as possible, really knowing your numbers, like controlling as much as you can control so that you can invest with confidence that when the market goes down, you're not going to need to pull it out and sort of, lose the rug from underneath your feet or anything like that. That's the best ways that you can counteract that fear that you're going to have for most of the time, to be honest, like, because at the end of the day, you're a human with emotions.
Yeah. And that spreadsheet and the long term, like we pulled up the chart before, that looks great, but like every little bump along the way is going to be felt, right? It's only when you look back over time, you're like, oh, that was easy. And so that's where, just being mindful of yourself and just being realistic and not putting yourself in a position that's...
And automating can help with that as well, right? Like, so if you've got an automated as like every 2 weeks it goes in, whether it's up or down, it's going in, that is a way that you can force yourself or basically take the emotion out of like, that investment consistently happening, because that is really, I guess, the risk-free way of making money over that long term is that consistency.
Yeah, bloody oath. Okay, so I've got two family-based questions for you. I know you've got kids. So these are two questions that I know your team deals with a lot as well. So the first question is actually, it's kind of like a two-parter, like a classic analyst question is like, what are two ways that people can save for kids' educational expenses? So these could be like super basic, Alex, or it could be like much more complicated. Like, I'm just curious, maybe even if it's things that people don't really know, or like just need a reminder on, that's cool too. But what are two ways parents, grandparents, what have you can start thinking about that?
Yeah. So first and foremost, which I sort of say to clients at the end of the day, whatever you're going to do, or can do sort of in this area is going to be better than doing nothing. Okay. So sometimes people do get really hung up on like, what's the perfect way to exactly do this? And at the end of the day, it's never going to be perfect because you can't predict the future. Okay. So just want to sort of start with that, is that anything will be better than nothing by a long shot. But broadly sort of giving you, I guess, some choices in terms of how you structure this. So the first one would be what's called an investment bond or an education bond. Okay, so investment bonds can be tax effective sort of long-term investment vehicles. So they're structured like life insurance policies behind the scenes, but they're designed for wealth accumulation. They've been around for a very, very long period of time as well. Not to be confused with like government bonds or corporate bonds. So from that, it's annoying they have the same name because
people get confused because they're like,
Yeah.
wait, so this is like that bond thing. I'm like, oh, it's a bit different.
Yeah, or James Bond or whatever. But nothing. All three are very separate things. So the biggest advantage for investment bonds is effectively if they're held for longer than 10 years, the earnings are only taxed at a maximum rate of 30%. Okay. And then any withdrawals after that 10 years, it's capped at that limit. Okay. So if you're a high income earner, so top marginal tax bracket, 47.5% is your sort of tax rate. If you've got this vehicle and you start drawing earnings after that 10 years, you're only paying 30% instead of 47.5. Okay. So it can be effective from that perspective. From an education bond is like an investment bond with a slight twist in that it can allow for withdrawals along the way, if approved. So tax-free withdrawals along the way for education expenses. Okay, so that can be quite handy, particularly if you've got an expensive sort of private high school, or you're planning to pay for university for your child. Like university in particular, this can be really good. High school, somewhat. Primary school, there's generally not enough time, to be honest. So yeah, it's more generally high school and uni where this can really work as well. So that's one option. Option two is you look to potentially put it in your name, put it in your partner's name, or potentially put it in, say, a trust. Okay, as in terms of a structure. Where you can work putting in your partner's name is if they're a lower income earner because they are largely looking after the kids, or they just, I don't know, they only work part-time for some reason, or whatever it is, and they're on a lower tax rate. That can be a great way to put money there, which will be in their name, to be clear, okay, which can be then invested to be drawn out for the kids later, if you want or not. Or you have potentially a family trust or discretionary trust, which you can use. Now, this will cost a little bit to set up. The advantage of this is the investments in the trust, which means you can distribute income each year depending on what's going on. So where this can be an advantage is, let's say you and I are a couple, okay? I'm going to work, I'm working full-time for the next 5 years as an example.
Sounds good to me.
But then we're going to do a bit of, you're working at home, you got it even harder. So, and then we're going to do a bit of a switch, okay? After that, I'm then going to be home more full-time and you're going to go back to the workforce per se. That's where a trust can be quite an advantage, because for the first 5 years, we just distribute whatever it earns to me on the lower tax bracket, and then we can switch it. So it gives us that flexibility, which is pretty cool. And then when our kids are now 18 and potentially say they are at uni, then we can start distributing to them as well, because then we can utilize their tax-free threshold of that first sort of 20 grand as well. So that can be quite a good structure to sort of set something like this up in as well. In terms of like the underlying investment in either of these structures or any of these structures, they are effectively going to be the same at the end of the day in terms of your choices. So you're looking at, there will be options for broad-based index funds. So the Australian share market or the American share market or a sort of total market approach as part of that as well. You will be limited in terms of your investment choice depending on the investment bond provider. Okay, so they'll have a menu list of what you can invest in and what you can't. The lists are normally relatively extensive, okay, but you will have more choices if you have your own trust or you invest in your own name as part of that too. Just quickly, you might see those kids accounts as well. A lot of the investment platforms have those too, okay? These work slightly differently again, okay? So again, they're still potentially similar to a trust structure, okay? But just be very careful from a tax perspective because often it will be in your own name, okay? So technically, you need to pay the tax on it along the way, and then you can potentially transfer it over to the child once they're 18, okay? The other alternative is you do it in the child's name, of which then the tax needs to be paid at the child's level, which is going to be top marginal rate and then some. I just point that out quickly because I know a lot of people they see those in terms of how because they're advertised quite a bit at the moment. But just, be careful understanding, I guess, the tax obligations and how that actually fits together, because that's probably something I see quite often people don't fully understand correctly as well.
So I feel like you gave us way more than two there, which we're happy for because you've basically broken down some of the major categories. But if I could probably highlight two of them, which is that you mentioned, obviously you mentioned just doing something's probably better than doing nothing. We'd like to say probably always. But two, there's the investment bond, which is sometimes goes by the name of an education bond, which can help with those educational expenses in a different way. And that's best done through a financial advisor. It's not the reason that I'm sure you mentioned it, but it is because a lot of those education bonds, the investment bond providers like to deal with financial planners more than the direct public. So that's one thing to consider. The other one is a family trust, which is great for family planning over the long term. There are some costs involved, so just be aware of those, but I love those, mate, so that's great. Maybe this next question is more for me selfishly, but basically whenever we get you on the air, I can ask questions like this. And this question is more, it doesn't have to necessarily be like super technical finance related. I'm just curious how you go about it. Like what's one tip that you would tell expecting parents or those maybe who already have kids and are just struggling to like get a system or just, manage their money effectively? Is there any, like, if you could just give us like a tidbit, maybe it's the way you do it, maybe it's the way you see other families do it, like a way to manage money more effectively?
Yeah, absolutely. And this is probably the way that I do it and the way that we advise clients to do it here at Everest Wealth as well. So the key factor or the tidbit at the end of the day is to really have a solid cash flow plan in place, which includes automation where possible. Okay, so but what I'm getting at there, and like a lot of clients that come through our doors and stuff like that, is they may know their cash flow to a degree, so they can be like, I think we sort of save say $1,500 a month, or most sort of months. But then what we'll do here is we generally get the data from the last 12 months to sort of see where spending has happened and how it sort of works, because then you capture obviously all seasons, birthdays, everything like that. And generally what happens is they may have saved $1,500 for the last 3 months, okay? But then, post that, there was a few months when they didn't save anything, and there was a few other months where they actually saved more, okay? So what they're doing there is that like recency bias, right? Like they think back, they're like, oh yeah, $1,500, because that's what they've done for the last 3. It's hard to think back over a full 12 months and be like, all right, what did I exactly do? So they're not then starting from an accurate place and then in terms of how they structure this going forward. So that's first and foremost. You want to really know your numbers. And then from there, you can build out a really good system, which you can then automate, which accounts for everything. So like a classic thing that we often see not accounted for is like holidays. Okay. So people always take holidays. They love holidays and they should have holidays. Okay. But it's not something that's necessarily in that cash flow planning or the family budget per se. So that's something that we always try to put in, which is because, you're going to want to take a holiday at the end of the day. Yeah. So then you talk about, where do you think you'll sort of go? Or like in a typical year, what would you sort of do? And let's then work back and make sure that's factored into the cash flow. So there's always money being put into that holiday bucket. So it's not something that we get to halfway through at the end of the year and go, oh, that's right, we're going to go to the Gold Coast. I forgot about that. And that's, that's $10,000 to fly the family. Like we didn't factor that in to what we were sort of doing. So that's really important. So you said just having that cash flow plan and automating it. So because when you've got young kids or expecting to have kids, like you got a lot going on as it is
Yeah.
with work and trying to
Bloody
be
oath.
social for parts that you can and whatnot. And I guess the other thing more for probably the expecting parents is forecasting out the effect of that 12 months off mat leave. Okay, so most people will typically take a full year off, or some people want to take more as well. That's perfectly fine, but it's about forecasting out and calculate, well, what's the impact going to be on our overall cash flow? You and I were chatting off air before, and you were saying potentially if you go down to one income one day, how's that going to affect things and stuff like that as well. Like it's a common thing to think about. So knowing what's going to happen is obviously a lot better, because then you can plan for that, as opposed to let's just see how it goes and hope it works out.
Yeah, bloody oath. It's yeah, the comment was before that, like, we were planning to move down to, we were thinking of it anyway. We're looking at moving down to the Mornington Peninsula here in Victoria, and we were effectively going to upgrade our property into something with a bit more land, and it was super expensive, at least by our standards. Like the Sydney side is probably like, hey, that's my first home, but I'm thinking this is like super expensive, and it's all well and good if there's two people, maybe in white collar jobs earning decent wages, but if it goes down to one, could you afford it? Well, maybe, but does it put you under a lot of pressure? Probably. So, like, what do you end up like? We've got some friends of ours that bought really nice houses or spent really big when interest rates are virtually nothing, and then found out, like, once they've had a family, that he was working 7 days a week, and so it was like just not necessarily the lifestyle that they had expected. So I think that kind of future proofing and forward looking is like one really cool thing, but you kind of match that with the backwards and the forwards there, which is great.
Yeah, because and I guess just to add onto that real quickly, it's like you said, it's the conversation sometimes is not just about, say, surviving that first 12 months. It's about what about after that, and because then you can have the conversation around like, so like you understand in the position that you're in or where we're at with what we spend and the mortgage we've got or whatever it is, based on all those variables, like you will need to return 3 or 4 days a week after that 12 months. And if that wasn't your plan, which is perfectly fine, then we need to make some changes. But the good thing about doing it, obviously, the earlier the better, is that you can make adjustments to make that again a reality. Because sometimes people just think about the first 12 months, which is still really good. Don't get me wrong, that's more than most, but it's about the effect after that and having that discussion around, like, as you can see, this 12 months, we're going to be negative, but that's okay because we've got $15,000 of savings, which will cover that. But then it's okay, what about after that? Like, we can't just be negative forever. Like, you're going to have to go back at least 3 days a week for us to break even on our cash flow.
Yeah, bloody earth. Okay, so I've got 2 super questions. Then I want to finish with one business question, one business owner question, which will probably benefit a lot of people, even if you're a freelancer right up. But my super question number 1 is, if you imagine a 35-year-old couple, and I know, like, you deal with many different clients, you offer personal advice at Everest, so it's like, it really depends on their situation and their goals. But just imagine like an average 35-year-old couple, maybe on one income. This is kind of like a 2-part question, which is like, what would be like a typical risk profile? And the reason I asked this question, Alex, as you know, is not necessarily about like, what is the risk profile? Like, how do you calculate that? It's more like when they go and look at their super fund, a lot of people are like, well, I've been told I should probably think about this, and a growth one's more more risky than a balanced one. But how do I know which one to select? So maybe it's like a 2-parter. It's like risk profiles, just general comments, and then secondly, like, is the balance strategy that most people see in their super fund right for middle to earlier age people? Like, is that right, or do you see typically that you extend to higher risk things? I don't know.
Yeah, great question. And something that we talk about all the time, because if you're working and living here in Australia, you're going to have a super fund at the end of the day. So there is money being put aside for your retirement, whether you like it or not. So it's best to engage with it early, because then that can actually make quite a big difference to your end result as part of that. So, like you said, most super funds, if you don't pick an investment option, you'll get put in typically their balanced option or their default option. So what that means, in theory, is it's a balanced split between defensive assets, which would be like cash as an example, and then growth assets, which would be like shares and property. Now, most balanced funds out there aren't a 50-50 split. They're generally more of a 60-40, maybe a 70-30. Okay, so that's probably another thing to note, because sometimes you may you may be of an age where you think balance is appropriate, or you really like 50-50. Again, I recommend you check the underlying asset allocation there, because it's actually rare that it's 50-50 at the end of the day, even though they call it balance. So you got to look at that, okay? And then I guess coming back to, the 35-year-old couple in this example, or any sort of person at any sort of age, it's always back to like, what's my investment time horizon or my investment time period? So the easiest way to think about that, in layman's terms, is how long until I want this money back is probably the easiest way to think about it. Now, with a super fund, it's effectively set in legislation when you can have it. All right. So let's just say it's 65, which it currently is for full access. Can get access from 60 to a degree, depending on some more criteria, but let's just call it 65 for ease of numbers. So this 35-year-old, it's 30 years before they're going to be able to access this. Now, if we go back to what we were sharing before, if you don't mind.
Yeah, I'll bring it up on the screen for anyone that's watching. This is the Vanguard interactive charts again.
Yeah, so this is a 30-year time period, right? So perfect for this 35-year-old in this example. So what we're saying here is down the bottom left, you've got $10,000, and you can take that $10,000 back in 1994 and you can put it into each of these different asset classes over here on the right, and you simply leave it, okay? So dividends are reinvested in this assumption as well, but effectively you don't add any more capital over that period of time. So it's okay, well, what does that $10,000 turn into after 30 years in these various asset classes? So in the US share market, it would turn into $237,000 or 11.1%. In the Australian share market, it would turn into $135,000 or 9.1%. And if it was in cash, it would turn into only $34,000 or 4.2%. Okay, so quite a huge difference there, right, between hundreds of thousands of dollars, literally, between sort of the top and the bottom in that example. So that's where, and you can basically take this chart back 150 years and you get a very similar result. Like long-term return of the S&P 500, which is the top 500 shares in America, is about 10%, a little bit over. So again, it comes back to thinking, well, what is my investment time frame? So if I'm 35, would a balanced or default option suit me best? Look, if I don't want to have as much short-term volatility, so I'd just really uncomfortable with it seeing it go down kind of ever, then yeah, maybe it is appropriate, but it's understanding that likely, based on the literature, that you are going to end up with a worse long-term result than potentially a higher growth portfolio, which may have, say, 90% exposure to growth assets like shares and property and only 10% to cash, as an example. But if you're further down the line, if you're if you're into your 50s or into your 60s or your 70s, as an example, and you're relying on that investment to produce some income, and you've kind of made your money, so you don't, you're not necessarily interested in growing your capital as much anymore. You just more want to protect it. Then yeah, more of that 50-50, or potentially even the other way, like you might have 70% cash and only 30% growth.
Yeah, that makes sense. And I think that's like the smoothing of the line is kind of the way I'd think about it. It's like as you get closer, you can smooth it. But in general, then, if I may paraphrase a little bit, I'd say that review your kind of super fund, know when you need the money or when you're going to get the money back, which in many instances is 65. And the longer that time away, the more you should consider those types of growth assets, even though they're volatile in the short term. If we go back now to another super question, this is one that's very topical for people in recent times, and I'm hoping you can just weigh in. And feel free to take this whatever way you want. But inside super, people will be familiar when they're trying to buy a house, they can use something called the First Home Super Saver Scheme.
Yep.
FHSSS.
No, it's only two. Well, I don't know. It's weird. Like some places do 2 S's, some places do 3. 3 S's makes more sense to me, but 2 S's I think is how it's...
Okay, so 2 or 3, it passes the test. You know what we're talking about. It's like the everyone that's listening to this would know because they've probably seen it around when they were looking at buying their first home. And there are a lot of rules around this, I should say. Well, not a lot, I don't want to scare people, but there are rules that you should know about eligibility and different criteria. Do you think that it is worth it?
Look, in a lot of circumstances, the answer is yes. So if you were to pin me down, more yes than no, I think is the answer there. But it does obviously depend on a few things. If we again just scale it back quickly to understand like what it is and what it does, the easiest way to understand it is effectively if you haven't bought a house before, okay, you're allowed to put extra money into your super fund. Okay, so it's not your employer contributions. This has to be extra money by yourself, either through a salary sacrifice agreement or you do a what's called personal contribution into super. You can effectively then draw that back out the other side to use towards your first home deposit. So why would you do that? Okay, to sum it up, which we'll go through in more detail in just a sec, but to sort of the key takeaway is you save tax by doing that, which effectively means you're able to boost your deposit from just saving it in your normal bank account or investing, or basically just saving it in your own name. Okay, because the reason for that is a super fund only pays tax of 15%. Okay, whereas most people are going to pay tax around sort of 30 to 32.5%. All right, as an example. So you're basically paying half the amount of tax than what you would typically pay.
What happens if you put this money into super and super fund goes down?
So one thing I actually don't know the answer to, which I would love to do, which I was talking about the other day, because how it sort of works in terms of what they deem like you earn on that money is a set deem rate. Okay, so the government basically goes, you put the 15 grand in, we take the 15% tax off that, and then effectively you earn a deemed rate, which what are they currently using? It's 4.78, I think, currently is the deem rate that they use. What I've never done, which I would love to do, is potentially put 15 grand into a separate super fund. So it's only got $15,000 in there. And then I don't know the answer. I haven't been able to get given the answer either in terms of like what actually happens if that does then go down.
Because you couldn't withdraw something that's not there, right?
The reason people listening why that typically probably hasn't happened is because most people aren't like me and nerd out around exactly how that would like to sort of cause an anarchy, but effectively because it would normally go into your own super fund, obviously.
Which has already got money in it.
Which obviously should have all $15,000 in there. Yeah, that's right. So, but you don't, whatever it does, regardless of the return, they deem that you do currently 4.78% per annum on that money going in.
Okay, so then you're basically saving money because the money that you put for your home deposit is in investment, which normally you wouldn't do anyway because you normally have it in savings or whatever.
Depending on your time frame, but
depending on your time frame. But because of the deemed rate and the fact that super is taxed at a lower rate, you're effectively able to, in the future, pull that out to then buy a house.
That's right. Yep.
Okay.
So in terms of, I guess, the sort of rules around that, is you can do up to $50,000 of extra contributions total, and the most you can do per financial year is $15,000.
Okay, so you couldn't just dump it all in at once. You couldn't put
you can't just do 50 grand in one go. 15,000 per financial year. So coming back to like your original question, is it good or is it bad? Like it is good, but you do need to have a little bit of forward planning on whether you're going to be able to use it in time or use it in a sort of time effective way as well. Once you've got your money in there and you're ready to start, say, looking for your house, or you effectively get your determination done. So it's all done through MyGov. It's actually pretty good. It's pretty straightforward, to be honest. We've had a lot of clients use it and haven't had too many clients come back asking questions exactly how to do it, which to me is a pretty good litmus test that it does work. You get that, and then you can get your money released. Just bear in mind, if you are doing this, it can take anywhere from up to a month to get that money into your hands. So normally it's around 2 weeks, but it can take up to a month. And then you've effectively got 12 months to then buy a house post that, which you can then actually get another 12-month extension on top of that, should you need to as well.
Because if you don't use the money to buy a house, then they'll be like, but this was just the whole point of this tax benefit was for you to get into a home, but you didn't use it that way, right? So that makes a lot of sense. Okay, so just allow time both in terms of using this strategy to accumulate wealth, but then also on the other side, don't be like oh my God, I need the money next week and otherwise my deposit's gone type of thing. Like be really careful about it. I like in a good way. But there's plenty of literature. I'll link to it in the show notes. I'll put it in the note down.
If I can maybe just bring up this table, I reckon this would be pretty good as well.
Yeah. For anyone that's watching.
So this kind of, I think, sort of surmises it pretty good. So this is based on someone earning 100K, by the way. So if you are in higher tax brackets, you are going to get a bigger tax saving, because effectively the difference between the 15% and your marginal tax rate will be greater. But this basically works out. Okay, so say this 100 grand person has $15,000 that they've earned money on. So they've earned money and then they've paid tax on that, which at 32.5% is just under $5 grand in terms of what they'll lose. Okay, so they'll have about a little over $10,000 that they can then invest at 4.78%, which is that deemed rate. They make $484. So effectively, they're left with $10,609 in that example.
So after the 15 grand, assuming they're not using this strategy, it's 10,600.
Yep, in the hand. I mean, again, that doesn't technically factor in the tax you pay on the 484, but yes, close enough, right? As part of that. 15,000 then taken and put, so you say you salary sacrifice that with your employer. So they take out a certain amount of money every week, fortnight, a month as part of that, to the equivalent of 15,000. That goes into super funds tax at 15%. So you lose $2,250 in that example.
So you're losing less than half.
That's right, less than half. Yep, you're left with 12,750 before you were only left with 10,125. That then earns investment at 4.78%, which is $718. You then withdraw that. Okay, you have to pay that extra Medicare levy amount on the way out, which is $393. But in the end, you're effectively left with $13,075 in this example versus $10,609. So just under a $2,500 difference in that example.
And that's just from one batch of 15 grand. So you could do that a few times over, right?
That's right. So call it, if you did it all the way up to 50 grand, you're going to save maybe like $8,000, maybe a little bit more.
Yeah, which is pretty substantial.
That's right. Yeah, it is.
Yeah.
And what you can do as well, sorry if I can just quickly interject, like where we use it more often or not, or can use it, is one of the cool things you can do is you can contribute money in the same financial year and withdraw it back. Okay. So where that can be beneficial is, so say right now you're thinking, end of the year, I might look to buy, or want to buy a house. Okay. And I've already got a lump sum of savings there as an example. You could use 15 of that this financial year to put in through a personal contribution. And then you could do it again, say in July. So you get 30 in, and then you could withdraw it from there.
Okay. Interesting. Yeah, cool. That makes a lot of sense. So you're using that kind of financial year effectively for you.
Yeah. Because in theory, you could do it 30th of June and then 1st of July, right? And get 30 in as opposed to 15. Now, the only caveat with that is you won't get the personal tax benefit until the following financial year. So you just need to be careful with that. But overall, you're going to be, say in this example, up from $2,500 better off to now $5,000 better off.
Yeah, because you've used it twice effectively.
That's right.
And you've done it within basically a 12-month period, even though it's effectively 2 years worth. Yeah, cool. That's great. That's nice. And I'm glad you shared that with us. So for anyone that's listening, don't worry, we'll put links in, but you can also just visit the YouTube video and check that out. Final question for you is a business question. As a business owner yourself, you've got a fantastic business at Everest. You're now expanding, or you've already expanded around the country, from the HQ, which is Perth, right around. If someone was sitting here watching or listening to this podcast and they're thinking, I want to start a business, or maybe they're already in the trenches a bit, you know what I mean? You know the feeling. What's one tip that you would have? Because you're uniquely qualified to give some particular types of strategies or tips or ideas or frameworks because you're a financial advisor and a business owner. What's one thing that you would say to someone running a business out there?
Yeah, so I've gone very basic, I guess, on my answer here, and there's lots of things that obviously you consider. So I may mention a couple of other things that may be like slightly up from completely basic, but I think to begin with, and this is assuming like you're just looking to start out right at the start, it's really important where we see a lot of people kind of stuff up to a degree is to separate the personal and the business finances from the very, very start. And that's where you see like stereotypically, tradies run into a little bit of trouble from time to time because it's kind of all blended up and they're not really aware of what's theirs and what's the business's. Okay. But then plenty of people in white collar do the exact same thing as well. Yeah. So having that clear separation for the start will just give you a really good, or a mindset of like, that's the company's or that's the business's, that's not mine yet. And this over here is mine. Added things to that is like, it just gives you a clear financial picture of what's going on because everything's basically separate. So then it's very easy to track, right? Because the business is over here. That's how much money is coming in. That's their expenses. My own income, my salary, which comes from my business or my profits. I've got my own expenses over here, which are completely personal. Tax efficiency as well, really like, in terms of, to your, giving it to your accountant and whatnot. It's very easy to be like, this is the account for the business. Okay. It's not all blended amongst all these accounts, which half this stuff's personal. And it means that nothing's missed that can be legitimately claimed and stuff like that as well, as part of it. And then you also get, a lot of, I guess fee saving on that perspective as well, because it is easy for the accountant to do your return. Then typically they charge an hourly rate per se, so they're gonna charge you less as well. So in terms of, I guess, again, how to start this, having your own separate business account with any of the sort of the major banks, they all do them, which is pretty easy. And then looking at, early on, where reasonable as well, to get like an accounting software like a Xero or a MyUp or a QuickBooks and stuff like that, which you need to get eventually, but simply having the separate business account to begin with may actually be sufficient for the first year anyway, because it's very easy then for the bookkeeper or the accountant to deal with that and not have to try and cross-check a whole bunch of different accounts, of which half of the stuff's personal as well.
Well, yeah, because if you're, say, in the case of a tradie and you're buying fuel from BP, but then there's something else purchased from BP, does that mean it's all for the business, or does it mean it's partly for the business? Like, having a separate bank account is just such good advice, because it just makes it so much easier. You'll save money on the accounting, you'll save money on the, it's just peace of mind too, really. And like, it's so good.
It can also be applied like all the time. I talk to clients about, like, if you have an investment property, like, have a separate account for the investment property. Just keep everything separate. Like, it's just so much easier to figure out, is it making money? Is it costing money? Oh yeah, I've got to chip in $200 a fortnight. Easy. That's really obvious, right? And again, from a tax efficiency perspective, it's like, here you go, Mr. or Mrs. Accountant. This is my investment property stuff. No, you don't need my other stuff because that's all personal. It's got nothing to do with the investment property. But a lot of people just, again, they just mash it all together. So yeah, that was a great example you gave with the BP. Like, you buy fuel and then you bought milk. So is the milk for the business, or was that for your, for your toddler back home? Is, because you find out the milk for the cereal. Like, it's
yeah, absolutely. No, that's great. I love it. From someone that's been running a business himself for a long time and been doing very well at it. I really appreciate you just taking it back to like the foundations there, because it is such good wisdom. Alex, people can check you out, get in contact with the team, and become a financial planning client. They can do that by a link in their YouTube or on their podcast player, but also head to the Everest Wealth website. I'll put a link in the show notes to all of the resources that we mentioned. Whether you're, like, just circling back on them, whether you're starting a family, you're thinking of using the First Home Super Saver scheme, you're wondering what's the fuss with all these investment bond type things, education bonds, there's something that's on the top of my mind. The different types of benefits that a financial planner can bring outside of just like the nuts and bolts, like not just like, well, I pay for financial advice, what's my ROI? It's like, what about when the uncertainty comes in, like when Trump comes in and puts a tariff on? Does that mean it's going to derail your long-term investing? Well, there's an infinite benefit from having someone that's been there before and seen it and can counsel you through that. So check out the team at Everest. Easily our biggest partner at Rask in terms of the amount of clients and community members that they serve. So Alex, I really appreciate you taking the time out, mate.
Yeah, thanks, Owen. Yeah, it's been good fun.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.